it's probably worthwhile you explaining why are they so scared of inflation, relatively speaking. I get if it's 20% inflation or 12, but like at 3% or 3.3% trimmed, what's the scary thing about it? So scary thing. Sorry, Lucy. The so scary.
I think that's a reasonable question. So if you look at the Act, it's always said, price stability is one of their mandates, full employment is the other. It also used to be there was this sort of general with the welfare of the Australian people mandate, but that was a bit less defined. And the changes that happened to the Act recently, it's now just price stability, so the inflation target, and full employment.
And full employment.
Yeah, so why does a central bank care about inflation, and why are they so keen to keep it really close to that? Not just their 2 to 3% target, but since this change in the governance and some of the arrangements, they're even more. It's not aiming for 2.5%. So part of it's just this is the job they've been given by the government. The statement on the conduct of monetary policy interprets the Act, and the statement says your target is 2 to 3%, but you should always be aiming for 2.5%. So that's why you remember last year, early last year, you had those forecasts where trimmed mean inflation forecast was 2.6%, and they were unhappy. And then it went down to 2.5%, and they started cutting rates. And it's like they're now treating it with that degree of fine tuning because that's the writing instructions they've been given from government. And maybe that is a little bit too rigid. I think the reasonable people can differ about that view. But why do central banks have inflation targets to begin with? And I think if you think about the history over decades and a century of central banks, they have a very powerful instrument. All of the transactions between banks happen across the books of the central bank. That's why it's called a central bank. If I bank with Westpac, obviously. If I go to the supermarket and I pay with my Westpac card, and it happens that the supermarket banks with a different bank, somehow my money's got to get to the supermarket's account with the other bank. And the way that happens is across the books of the central bank. The two banks have accounts with the RBA, and the money goes between them. That's how it works. That's called clearing and settlement of funds. It's how the payment system works in Australia. So any central bank, because of its nature at the centre of the banking system, it gets to decide what interest rate it will pay on its own liabilities. That's the cash rate. That's the rate on its exchange settlement funds. And because it controls that, it can also influence the rate that's paid on the cash rate, which is the rate that banks borrow between each other overnight. And that just happens to be, even though it's a small market, it's an incredibly powerful lever across all the other interest rates. So then the question is, what should the central bank do with that? What should they pursue? And after many decades of pursuing all sorts of other things, is they've realised the best single thing that we can do to make the country a better place is to make sure that inflation doesn't get out of hand.
Which is what they mean by price stability.
Correct. So make sure inflation doesn't get out of hand. That means keeping it anchored, the rate of inflation anchored low enough that no one really cares about it. That's not an issue. It's not 10%. It's not 5%. It's low enough. Positive's good because you don't actually want prices falling all the time and people actually struggling. If you've got a debt that's in dollar terms and then prices and incomes are falling, that's bad. So a small positive rate of inflation that's sort of just enough that no one really cares about it, but not so low that you end up with interest rates hitting zero. That's what you should aim for. And that realisation that that's what central banks were best equipped to do in terms of, making things better for the overall society was something that took quite a while, many decades to sort of land on. It was really only in the 1990s that this idea of an inflation target, an unchanging inflation target, really took hold. And it doesn't really matter if it's 2, as it is in most countries, or 2.5, as it is in Australia, as long as you pick a number and stick to it. Because then people can kind of think through that, they can work on that basis, they can plan on that basis.
And it's stable. It's about stability.
It's about stability, but it's about being able to plan, but also having inflation low enough that people don't need to care about it. Because once they have to start thinking about inflation, that's when you get a lot of distortions, when you get people making decisions that are about avoiding inflation rather than, is this a good investment? Is this a business that will make money? So it's actually better for long-term growth if you have low inflation. Countries with high inflation don't have strong growth.
I appreciate that explanation on price stability. Also, we've got, you said the words before, full employment. Full employment, there's probably no such thing, but it's measured by unemployment.
There's a bit more to it than that. And again, after the RBA review, there's sort of a bit of a fleshing out.
Which is 2024.
Yeah, that's right.
Yep.
So there was a bit of a fleshing out. I mean, the inquiry happened, the report came down in 2023. It was just these two events are not related, but just before the report came down just before I left. So they've been implementing it since then. So full employment, I mean, in the end, high unemployment or underemployment is bad. Being able to work is part of human dignity. And, we've known ever since the Great Depression that having high unemployment is just terrible for a society. And so again, although, the RBA can't make, the trend rate of unemployment even lower, it can make sure that you don't end up too much higher than whatever that sort of sustainable rate of labour market slack is. And so that's sort of unemployment, but there's a bit more to it than that. There's also, remember I mentioned earlier, people, when interest rates go up, people go, oh, I'm going to take a second job to pay my mortgage. Well, to the extent that there are people who would like more hours but can't get them, or they're not actively looking for work right now, but they really would like a job, but then, for whatever reason, they're not available this week, then they don't count as officially unemployed, but they're sort of out there as labour market slack. And so whether you measure it as just purely the unemployment rate, because that's the bit that's kind of the worst experience for people. I mean, having a job but not having enough hours is probably less bad than being outright unemployed.
Or if you have 1 hour.
Yeah, with 1 hour. But that's the thing. So being underemployed is bad. Being totally unemployed is presumably worse for most people. And so we know that this is a bad thing for society to have high unemployment, and particularly high long-term unemployment. And so that's something that central banks, but also other policymakers, need to be mindful of. You need to make sure that people who want to work have a reasonable chance of finding a suitable job.
And so this sort of new emphasis, perhaps call it new emphasis or a refined emphasis on price stability and full employment, which is where the Reserve Bank is these days. Back, I think, June last year, we sort of had quite a low trim mean for inflation, and I think unemployment was even pretty low, 4.1, which is like the sweet spot. Perfect. But of course, that's sort of changed a little bit, quite a lot. We know 2.5% is the sweet spot for inflation. What's the sweet spot then for unemployment as a measure of full employment?
It's not a fixed number, and I think this is the difficulty.
Do they have a number in their mind, though?
At any given point, there is sort of a number in their mind, and it gets revealed under freedom of information laws whenever journalists ask for it. So it is something they estimate, but they've made it quite clear in their public documents that it's not just about unemployment. They use other things to assess how tight the labour market is. And so there's a certain element of judgment, there's a certain element of modelling, but there's a whole history of academic literature that says, at any given point in time, there is an unemployment rate below which wages growth and inflation start picking up, and above which wages growth and inflation start slowing. Alternatively, another way of framing it is there's a rate of unemployment that's consistent with inflation at target, and below that you end up with inflation above target, and above that you end up with inflation below target, too hot, too low. So whether it's sort of a levels difference from target or a quickening slowing, and different models have different implications there, but essentially there's a sweet spot at any one time where the degree of labour market slack is consistent with inflation remaining stable at the inflation target. So the inflation target is a number, but the full employment is kind of a moving number. And I think this is where different people will have different views. So you might recall that when interest rates were rising in sort of 2023, the Reserve Bank made a decision not to go as hard as, say, Canada or New Zealand. And they were criticised for it at the time.
100% they were.
But the rationale for it was, firstly, you didn't buy that much additional disinflation for that extra 50-odd basis points, but you bought a lot of extra unemployment.
You kept your unemployment low. Is that right?
So that's the thing. So unemployment increased a lot more in New Zealand and Canada and some other countries than it did in Australia. So, that was part of the story.
It was sort of like a bit of an experiment. How can we balance these two well?
But there was an additional element that's not really well understood. So firstly, it was just, the trade-off wasn't great for the, as long as you'd tightened policy as much as we did, you got pretty much the same amount of disinflation as everyone else. And that's true. We did. Inflation did go back to target, albeit briefly, in the middle of last year. So the peak wasn't that different. The trough, the rate of decline was pretty similar. There was no sort of real sense in which inflation behaved that differently up until the middle of last year in Australia than those other countries, but we got a lot lower unemployment for it. So you could say, well, that judgment looked like it had been vindicated. There was another wrinkle to this, though, that I think a lot of people haven't understood, because that sustainable rate of unemployment, well, where does it come from? Like, why is that why is whatever it is at the moment the magic number? Now, the way the RBA measures it is just basically, well, if inflation's too high, it must be that where unemployment's below that number, that magic number. And if inflation is too low, we must be above it. But there's things going on there. It's, the match of people to the skills that are needed. It's the willingness of work, firms to take on someone who maybe doesn't have the same, isn't already fully trained.
Or English is not so good, blah, blah, blah.
Or any of those things. But I mean, in particular,
a lot of variables.
Are you already qualified? I want someone who's fully cooked or not. Those sort of things. But what happens is, if you have a period where the labour market's a bit tight, and so people are starting to get a go that they might not have when unemployment was higher, well, all of a sudden those people become much more viable in those roles. And so there's a horrible Greek word, like ancient Greek word for it, which is called hysteresis. But it basically means if you run the labour market a bit tight, well, then afterwards you can kind of keep running, it's no longer feels so tight, and you can actually sustain that unemployment rate or something close to it as sustainable without inflation picking up. But similarly, if you have a really big increase in unemployment, and so you have people who are unemployed for a long period of time, that makes them less able to sort of compete for the jobs. Someone looks at someone who's been out of work for 2 years, it's like, why would I hire you? And so you get this, again, this path dependence. And this is what happened in the 80s. We had high unemployment, and high unemployment begets high unemployment because it effectively drags up that sustainable rate of unemployment. So part of the rationale behind what the RBA did was, you didn't want to run the labour market so hot that just inflation exploded and wages growth exploded. But you just wanted to run it a little bit hot in order to drag down that sustainable rate of unemployment. And I think that's something a lot of people have lost sight of.